Hello fellow human, nobody here with a new stock analysis. Today's question is, should you buy Supermicro computer shares? The answer might feel unpleasant like a cold shower, but hopefully it will also benefit you like a cold shower. As always, I will jump straight into my verdict and I will follow with my reasons afterward. Let's go! At today's price of $910, Supermicro computer stock is a sell. My price target for 2026 is between $200 and $580. For an average of $390 per share. This means I believe the current share price is out of touch with reality and wouldn't be reasonable even in 2026. Just like in Micron's case, people have been purchasing SMCI shares like crazy over the past 15 months in an attempt to capitalize early on the AI revolution. Shares are now insanely expensive and are bound to play a mean prank on investors. Look, as you can tell from my other videos, I have nothing but the highest expectations for artificial intelligence. But you do need to take a look at the price tag. You cannot just blindly buy shares from every company related to AI and expect to make a killing. I know, this is not what people are saying about Supermicro. The company has this super special relationship with Nvidia and they will happily go hand in hand, skipping into the sunset. Right, we'll see about that, but first, a little disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. Supermicro Computer designs, manufactures and sells highly customizable, high-performance server and storage solutions. This includes server hardware, software and networking equipment for data centers, cloud computing, edge computing, 5G and artificial intelligence applications. To be more specific, the company offers server systems, high-capacity storage products, advanced networking products, specialized embedded and IoT devices, high-performance professional workstations, system management and optimization software, energy-efficient products and cooling technologies, and technical support and consulting services. Now, all of this sounds more complicated than it needs to. Simplifying it a little bit, servers, such as the ones in data centers, are structured in racks. And a rack is more or less the equivalent of the case or tower in a PC. Supermicro simply buys all the components from other companies and puts them together, creating the final usable racks. Naturally, there is little moat in this kind of putting things together business, which is why the company's margins are very low. But it does its best to differentiate itself, focusing on making its solutions as energy efficient and cost effective for its customers as possible. This is all good, but many people go overboard claiming that the company has this miracle liquid cooling technology. If it's so special, you would expect to see it reflected in the numbers, now wouldn't you? Let's start by checking how the company has been growing. In the past 10 years, the average annual growth was 19.9% for revenue and 37.3% for earnings. As you can see on the chart, growth has seen an astounding acceleration since 2022. Although it pales in comparison, growth until then had been perfectly respectable. But the last 3 years have been just insane. I guess you got me then. This incredible growth proves that Supermicro is truly special, right? Not really. If the company were successfully gaining a competitive advantage, we would see a large profitability improvement. The revenue and earnings estimates for 2026 imply a net income margin of 8.4%. Higher than the historical average, yes, but it still shows that the company will very likely continue to have limited pricing power. Also, just because the company is growing fast, it doesn't mean it is gaining market share. Its competitors, and the low margins suggest there are plenty of competitors, might be growing even faster. To be fair, all I'm saying is that the company doesn't show signs of being very unique. However, even if the low margins can be a red flag, future growth is equally valuable. So let's take a look. For the coming 3 years, analysts expect the company to achieve an average annual growth of 58.2% for revenue and 52.4% for earnings. The company is expected to increase both revenue and earnings almost fourfold in 3 years, between 2023 and 2026. You heard that right, sales from 7 billion to 28 billion and earnings from 11.4 to $40.5 per share. Mind-blowing. And obviously, all things being equal, this kind of growth deserves huge stock returns. The question is, how much has the stock already priced in? Is there room for further upside? We need to take a look at the valuation. As you can see, valuation multiples are much higher today than their 17-year averages. One glimmer of hope is that the PEG ratio is rather low, but by itself it is just not sufficient to justify an investment. For almost 20 years, investors have clearly shown how much they are willing to pay for this razor-thin margin business. And despite the much increased demand, the nature of the business and its competitive environment have not changed all that much. So, despite a most glorious revenue and earnings growth, shares are looking quite expensive. This is because with the stock returning 43.2% per year over the past 10 years, the share price has far outstripped the growth of the company. 3 years ago, the stock was $34 and the multiples were looking pretty average. In just 3 years, the stock has gone from $34 to $910, a 26-fold increase. 26. Revenue and earnings have gone up by a lot and are expected to continue to do so. But this pales in comparison to what the share price has done. Just another case of investors buying without looking at the price tag. Some people seem to buy right after hearing AI, some buy after seeing the company's monster growth. But few seem to know that valuation is not optional. In conclusion, I expect the stock to lose half its value in the coming 3 years. The company itself has tremendous growth, but the share price got way ahead of itself. Low margins will most likely continue to attract low valuation multiples. Interestingly, a whopping 27% of shares are in the hands of retail investors. Sometimes the rich do take the money from the poor, but more often than not, it is the poor who willingly give their money away. If you found this video only mildly upsetting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.